In this episode, we're going to explore what it means to be a day trader. You'll learn what a day trader is, why people like it, and how it compares to other styles of trading. Before we dive in, don't forget to like this video and subscribe to the channel. It really helps us keep producing valuable content for traders like you. Let's get started. So, what is a day trader? In simple terms, a day trader is someone who buys and sells financial instruments like stocks, forex, commodities, or crypto within the same trading day. That means they don't leave any trades open overnight. By the time the market closes, they've closed out all their positions. The goal of a day trader is to take advantage of small price movements during the day. They look for opportunities where they can make small but frequent profits as prices go up and down. Many day traders make 1 or 2 trades in a session, depending on their strategy and the market conditions. Now for the big question. Why do people choose day trading? Well, one reason is that it helps avoid something called overnight risk. When you don't hold trades overnight, you don't have to worry about big price changes that might happen while the markets are closed because of breaking news or unexpected events. An example is stocks which are traded during the day. World, economic, or specific company news could result in a stock experiencing overnight gaps. This is where the price of the stock jumps between one day's close and the next day's open, leaving you with either a huge profit or hitting your stop loss. Another example is the forex market, which operates 24 hours a day, 5 days a week. Trading moves between the London, New York, and Asian trading session, meaning that there are always institutions and traders moving the market price whilst you're asleep. Another positive is that day trading can give you fast feedback. By the end of the day, you know whether your trade worked out or not. For some people, this quick pace and the chance to make frequent decisions is part of the excitement. As your money is made or lost during that day, you have the opportunity to regularly withdraw these profits rather than having to wait several days. Day trading also gives you a lot of control over your positions. You're actively analysing and managing your trades throughout the day, which can be appealing if you like to stay hands-on. On the flip side, day trading isn't easy. It can be stressful because markets move fast and decisions have to be made quickly. It takes focus, discipline, and often long hours at the screen. There's also the risk of overtrading. That's when you take too many trades, often out of impatience or emotion, which can lead to losses. And finally, the costs can add up. Even with low commissions, trading frequently means you'll pay more in fees and spreads. That's the small difference between the buying price and the selling price. So, how popular is day trading? Day trading has become incredibly popular in recent years, especially as online platforms and apps have made it easier for retail traders to access real-time data and low-cost trades. In fact, the rise of commission-free brokers and easy-to-use charting tools has opened the doors for more people to give it a try. During the COVID-19 lockdowns, day trading saw a surge in interest, as many people looked for ways to generate income or simply to stay engaged during uncertain times. So, what timeframes do day traders use? When it comes to timing, day traders usually work on shorter timeframes. They might look at charts that show 1-minute, 5-minute, or 15-minute price movements for their entry, and 1-hour charts to understand the bias for the day. Any charts greater than 1 hour, such as the 4-hour, daily, or weekly, are great to estimate the long-term market sentiment or direction. But price action can fluctuate a lot within this time period. Using lower time frame charts will help to spot short-term trends and patterns that day traders can act upon quickly. The key is that no matter how long a day trader holds an individual trade, they close everything before the market shuts for the day. Are there legal restrictions? If you're trading in the United States, there's an important rule you need to know about. It's called the Pattern Day Trader Rule, or PDT rule for short. This rule says that if you make 4 or more day trades within 5 business days using a margin account, you need to have at least $25,000 in your account. If you have less than that, you can still day trade, but you'll need to limit how often you do it, or stick to a cash account. In the United Kingdom, there isn't a direct equivalent of this rule. Retail traders are free to day trade as often as they like. But of course, you should always stay aware of tax rules and make sure you're following the regulations that apply to you. As a teaser, there is a way to trade tax-free in the UK using a spread betting account. We'll discuss this more in later episodes. So, let's compare day trading to some of the other trading styles out there. Day trading is fast-paced. You need to be confident and decisive, as price action on the lower time frame charts moves quickly. This can be high stress if it doesn't suit your personality. Trades usually last from a few minutes to several hours within the day. Typically, people take 1 to 5 trades per day. This can help to keep trading costs low, as you're taking less trades than a scalper and holding them longer, potentially earning more profit. Day traders can often make their daily profit target from a couple of trades. A scalper would need to take many trades to achieve this same profit with a comparable sized account. Day trading allows you more time for market analysis when compared to scalping, so is more friendly to beginners who are learning to read the charts. Day traders will typically use higher time frame charts for analysis. These charts contain more data than the lower time frame, so are arguably less choppy and easier to see a trend. Swing trading offers similar benefits to day trading, such as more time for analysis, and requires less trades to make the same profit on a comparable account size. Swing trading also uses higher time frame charts, which are easier to read. The negative is that you are exposed to overnight news without the ability to exit the trade early if the market sentiment has changed. You may also need to pay overnight fees. Position trading or investing are very long-term trading styles, which are very different to intraday trading. For this reason, it has not been considered within this comparison. If you enjoyed this video, please give it a thumbs up and subscribe. Also, take a look at our next video where we'll explore swing trading in depth. Thanks for watching, and I'll see you in the next one.